We have spent the last few years watching artificial intelligence software perform tasks that were recently considered impossible. The public fascination has been fixed on the intelligence itself, the algorithms and the chat interfaces that have become the public face of the boom. OpenAI ended 2025 with approximately $20 billion in annual recurring revenue. For a pure software provider, that represents a threefold increase in revenue in a single year. This chart shows the scale of the investment happening behind that revenue. In 2026, the 5 largest tech companies are committing up to $690 billion to capital expenditure, nearly double their 2025 levels. That does not include the Stargate project, targeting $500 billion in infrastructure by 2029. With 7 gigawatts of capacity planned across 5 initial sites, the project represents a massive, compounding layer of physical investment. This scale of capital commitment indicates that the primary challenge for AI development is no longer the logic of the code, but the physical constraints of the hardware. The first constraint is the processing chip. Hyperscalers currently rely on off-the-shelf merchant GPUs, but the high cost of these processors limits their long-term margins as they attempt to scale their own AI services. To reduce these costs, technology giants are designing their own custom ASICs, application-specific integrated circuits. These chips are engineered to perform specific AI tasks more efficiently than a general-purpose processor. Custom ASICs will account for 28% of the 2026 AI compute market. Their 45% growth triples standard GPUs. Tech giants rely on partners like Broadcom and Marvell, who control 95% of the custom AI ASIC market. By providing the architectural foundations for these custom chips, these two firms have positioned themselves as the primary beneficiaries of the move away from off-the-shelf silicon. Even the fastest custom processors face a physical limit in how quickly they can receive data. There is a growing gap between the speed of the chip and the speed of the memory feeding it. This is the memory wall. An AI processor stalls and performance drops if it cannot access data fast enough to keep its circuits busy. To solve this, manufacturers are deploying high-bandwidth memory, or HBM4. The South Korean manufacturer SK hynix has emerged as the dominant supplier of this specialized memory, essential for frontier-level AI systems. This line graph shows the financial result of that technical dominance. In the first quarter of 2026, SK hynix posted a revenue increase of 198%, reaching 52.58 trillion won. Because AI performance is fundamentally memory-bound, memory fabricators now hold significant pricing power over the companies designing the actual processors. Connecting 1 million AI chips into a single cluster creates a networking crisis. Standard data center connections cannot handle the massive, real-time data flow required for modern training jobs. Arista Networks has addressed this by deploying 1.6 terabit platforms. By solving these traffic jams, they expect to double their AI networking revenue in 2026. However, the density of this compute power creates a final physical barrier. Traditional data centers were not designed to handle the intense heat and power consumption of modern AI clusters. The power demand is unprecedented. AI data center consumption is projected to reach 6% of the entire US electrical grid by 2026. This makes firms like Vertiv essential. They provide proprietary liquid cooling and on-site power generation, preventing facilities from overwhelming the grid. These developments confirm that the AI revolution is moving as fast as the physical availability of glass, copper, and cooling water allows. Why are these massive tech companies committing nearly $700 billion to infrastructure before enterprise software demand has fully matured? Data from the World Economic Forum 2026 report reveals the primary catalyst. Approximately 170 million new AI roles are being created, and workers with demonstrable AI skills are earning a 56% wage premium. This creates a flywheel effect. To attract top workers, companies must provide expected AI workflows, forcing rapid infrastructure build-outs. In the bull case, this cycle sustains high demand for infrastructure providers for the next decade, as liquid cooling and custom silicon become standard. The risk is that this infrastructure is being built well ahead of the revenue it generates. If enterprise adoption slows, the industry faces a brutal cyclical bust from overcapacity. The 2026 infrastructure sprint demonstrates that while software captures the public imagination, the most significant capital is flowing to the companies managing the physical foundations and power grids that make that software possible.